In this week's highlight, we'll see how the highly anticipated stock index futures might work as an investment option for you. We'll also hear from a financial analyst about the potential impact of this new instrument on the domestic market. Preparations to launch China's stock index futures trading have entered the final stage. The state securities watchdog have licensed the first two commodity futures companies to operate a brokerage business in financial futures. While no specific launch date of the product has been unveiled, Li Zhuamiao takes a closer look at the first financial futures product in China.
More than 40,000 investors took part in a mock trading session for stock index futures, and within a month, some contestants saw their virtual capital grow by more than 20 times. Organizers of the event say the trial session prepares investors for the new product and demonstrates how financial futures work.
Through stock index futures, more investors will be able to hedge risk. They can gain profit through speculation. The gains will be big, but so will the risk.
Stock index futures are traded in terms of number of contracts. Each contract is used to buy or sell a fixed value of the index. The value of the index is defined as the value of the index multiplied by the specified monetary amount. The China Financial Futures Exchange stipulates the value of the futures contracts will be the points of the composite 300 index multiplied by 300 yuan. Investors are required to put up 10% of a contract's value to trade the futures. For instance, if the market closes at 4,000 points, an investor will have to put up 120,000 yuan to trade the contract, valued at 1.2 million yuan.
The Chinese stock market boasts great volatility and is easily impacted by outside forces. The introduction of index futures will reduce the volatility in the underlying index due to the close link between the futures and the real market.
Trading in stock index futures contracts was introduced by the Kansas City Board of Trade on February 24, 1982. In April that year, the Chicago Mercantile Exchange began trading in futures contracts based on the Standard & Poor's Index of 500 common stocks. The introduction of both contracts was successful, especially the S&P 500 futures contract currently used by most institutional investors.
We should introduce stock index futures first, which is the most simple, simplest product, and then you expand into interest rates and currency products. We should encourage the growth of institutional investors, and they should be the ones that participate in the market first. So all these are the lessons that other markets have experienced, and we can learn from them.
Dr. Fang, who used to be Deputy General Manager of the Shanghai Stock Exchange, says the government wants to introduce more financial products after the futures index is launched. As Asia's second largest equity market, China's two bourses have almost doubled this year. Li Zhuamiao for BizWatch.
Investors are now looking to the hyped-up stock index futures to rake in huge profits. But will it really shake up the mainland securities market? This week, I interviewed George Yan, Investment Director at HSBC Jin Trust Fund Management Company. He analyzed the potential impact of this new financial instrument and the role it will play in one's investment portfolio. How will the introduction of the stock index futures impact the Chinese securities market overall?
First, we don't think the introduction of the index future will change the market trend, but we think the introduction will cause the market oscillation. We studied lots of countries' market before and after the introduction of future index future, and we find most of the market will go up before the introduction and fall after the introduction of index future.
How long a time period are we talking about here?
Normally a month before and after.
And after a month, everything will be back to normal?
Yeah. So that's why we see the market trend will not change.
What about the opportunities to investors? What new opportunities will this bring to Chinese investors?
For institutional investors, if we think the market will fall in the next several months, for example, then we don't have to sell all the shares on our hand. Instead of that action, we can establish the short position in the future market. So that means we have another new instrument on our hand.
So basically another option for investment.
Yes.
And you can bring that into your portfolio. Some analysts say that the high entry requirement for trading the stock index futures will turn on a lot of individual investors, and basically institutional investors will be the major player. Do you agree?
I would like to divide it into all the investors in the market into two kinds. One is the larger scale investors. The others are small scale investors. For those larger scale investors, for example, institutional investors, they are the dominator of the market, while the others, the small investors, they are just the market followers. So for both of them, if they can make the correct judgment of the market, then they can take profit.
So you're saying there are still opportunities for even the individual investors if they make the right decision.
Right.
From the investor's perspective, what would be the potential risks related to this new instrument or investment product?
Margin, I think. Margin is always a devil for most of the marginal users. So for those investors, both institutional investors and individual investors, I would like to give them the advice: don't use too much margin, and don't use the margin at any time.
In the mature market, is stock index futures a heavy portion of their overall portfolio, or is it just a small part of it?
Stock futures is just an instrument. So of course the overseas investors should take it as an instrument into the portfolio. So I think they just try to hedge the systematic risks, and then they can focus on those valuable shares. That's why they can hold valuable companies' shares for a very, very long time if they think the stocks is very good. Well, if they think the market will fall, for example, they will set their short position in the futures market.
So basically, if I understand correctly, it's an instrument for you to hedge against risks, right?
Normally the systematic risks, not the unsystematic risks, because if they try to avoid the unsystematic risks, then they try to understand the company very well. That's what they should do, and what they only can do.
George reiterated that stock index futures will affect liquidity in the market by offering investors another option to hedge risks.